Okay. Let's read this question. We are told that Kaoyen Limited has issued 10,000 shillings par value, 10-year bond with a coupon rate of 12% per annum. The bond is currently trading at 830 shillings and is callable at shilling 10,500 after 5 years. Required yield to maturity and then yield to call. So here in this question, examiner wanted us to compute or to get the yield to maturity and yield to call. And remember yield to maturity is part of the formula of getting the KD, the cost of debenture. Once you compute the KD, we subject to tax. That is our KD. Once we subject to the YTM and then we subject to tax, that is our what? That is our cost of debt. Now in this case, examiner just wanted us to compute the YTM or yield to maturity. So keep on yield to maturity. So YTM class, that is where we are. So YTM, that is yield to maturity. Tuseme inapatianwa na interest plus 1 over n par value minus market value divided by a half par value plus market value. If you remember, that is the formula of getting YTM. Now in this case, class, we have everything. What is the rate of interest? What is the interest rate here in our case? Somebody, very fast. Our rate is no. Hapana, Walter tuelewane. When we now subject to tax, hiyo sasa inakuwa nini? Inakuwa KD, cost of debenture. Lakini saa hii wanataka YTM peke yake. Kumbuka ile formula ya KD ndio sasa tunataka 1 minus T. Please note that. So the interest from Mokadoni is 12% of par. What is our par value? We, male, shida iko wapi? Oh, male. Okay, I understand then. Male, you want us to use English, huh? All right, there's no problem. All right. So what is our par value from the question? Just look at the question. You need to have the question. 10,000. So we're looking at the interest. So that will be the interest plus 1 over n. Class, our n is number of years. How many years do we have here? We have 10 years. And then our par value ni ngapi? It's 10,000 minus our market value. What is our market value? Everything is given here, by the way. This examiner just wanted these people to pass. So what is our? It's semi-annually. Okay, it's semi-annually. Semi-annually will just affect our interest. Asante. Semi-annually will just affect our interest. Yes, it will just affect our interest. So it is times 1 over 2. Asante. Thank you so much. Yes, it's semi-annually. Yeah, interest is paid semi-annually. So our interest will be semi-annually like that. Good. Now our market value ni ngapi? Market value tumepewa 88.30, right? 88.30. Now that is our par value. We divide all these divide by our half of 10,000 plus 88.30. You know what? That will give you your YTM. Once you compute this, you get your YTM. Now, you can give us the YTM, or you can give us the first part. Give us the first part. So this is 6% of this. Kaya natuambia n will be 20. N will be 20. But remember here, Karen, we're not compounding. Sawa. You're not trying we're not investing in that case. You're not investing in that case. Karen anatuambia n shall be 20. N shall be 20. Karen Power anatuambia n shall be 20. Soma swali tena. Karen Limited has issued a 10,000 per value 10-year bond with a coupon rate of 12% per annum. The bond is currently trading at 830 shillings and is callable at 10,500 after five years. 5 years. All right. Okay. It is the interest is earned semi-annually. The interest is earned semi-annually. We're going to compute the yield to maturity. Yield to maturity. Are we looking at the intrinsic value here? Looking at the intrinsic value? No. We are trying to look at what? The yield. What are some of the yield we shall be having at the end of the period? At the end of the period. 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 So Karen, what shall we have here? Now, when we go to the callable period, the callable period, we have 5 years. We have 5 years. Now we shall subject our 2 there. We shall subject our 2 there because there will be 2 calls. 2 calls for 5 years, another 5 years. For 5 years, another 5 years. So that is where our 2 will apply. Our 2 will apply. But for the first one, for the YTM, we shall have 10. So give me this. A half of 12, that is 6% of 10,000. What is 6% of 10,000? This one, but yeah. So it is 600. Let's just go step by step. 6,000 plus. So 1 over 10 of this, 1 over 10 of that difference, 1 over 10 of that difference, we just put it here. Maybe if there is a decimal to 2 decimal places, 117. So 117 divided by a half of the total of the 2. A half of the total of the 2. That is what we are dividing with. That is what we are dividing with. A half of the 2. 94.15. So we shall divide with 94.15. Now, class, can you tell us what will be our yield to maturity? Yield to maturity. Maturity. Or yield to maturity. It is 0.07. So if you wish, you can say it is into percentage, maybe 7%. When it comes to the yield to call, the only difference will be that we shall now change the callable what? The callable amount. This market value, we shall replace with the callable amount. So it will be just the same, perhaps. Or interest, half of interest, 12% times 10,000 per value remain, times 10,000, so that's the same, plus 1 over 10. Remember now here we shall multiply our callable for 5 years. 5 years we have a call. After another 5 years, another call. So times 2, and then we do what? We multiply by 10,000 minus 10,500, that is the difference, divide by, here class we shall divide by a half of 10,000 plus 10,500 plus 10,500 plus 10,500 plus 10,500. Now, you now ukifanya yote itapatia nini? Just do the whole of that and we get the figure here. We get the figure. I expect that it will be lower of this, or that. Tutapata ngapi pale? How much shall we get? How much? Fanye tu yote. Patia hiyo. Okay, 0.054, 0.054. So 0.54. So the year to call semi-annually is this. So if you want to get per annum, you can multiply this by 2. You can multiply this by 2. This will be something to do with maybe 14%, like that. So that will be the yield call. So class, let's look at our weighted average cost of capital, WACC. Weighted average cost of capital. 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 Good. Semi-annually will not affect. Then the N. Yes, male, that's what we said. That's what we said. But now later, if you now want to get if you now want to get this rate or this yield to maturity as a per annum, you multiply this by 2, you multiply this by 2, you multiply this by 2, you multiply by 2. Okay, let's look at the weighted average cost of capital. Weighted average cost of capital. Class, we have been using these cost of capital. Well, examiner usually provide us with the cost of capital. We don't know how this cost of capital is arrived at. Now, through this, we shall be able to see or to look at how we arrive at this cost of capital, or how companies or organizations do arrive at this cost of capital. And through that, we shall be able to do what? To solve several questions. We shall be able to solve several questions. So class, this is what we have. Just say that it is used to calculate the cost of capital. It is used to calculate the cost of capital. It is used to calculate the cost of capital. Whenever we are calculating historical cost, it is used to calculate the cost of capital whenever we are calculating what? The historical cost, the historical cost, the historical cost. It entails raising a historical fund by undertaking historical what? Project. It entails raising historical fund by undertaking historical project, by undertaking historical project, by undertaking historical project. Now we have some steps in calculating WACC. So we call these WACC, 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 WACC. We abbreviate it as that, WACC. So class, let's look at okay, here ya pili. It entails raising historical funds. It entails raising historical funds. It entails raising historical funds by undertaking what? Historical project. By undertaking historical project. It entails raising historical funds by undertaking historical project. I hope we are together now. I hope we are together now. Good. Let's look at our steps in calculating WACC. Class, we have 4 steps in calculating the WACC. For us to be able to compute this WACC, we have 4 steps, and this is highly examinable. This is highly examinable. Therefore, we should be very keen on it. So step number 1, class, is to calculate the component cost of capital. Is to calculate the component cost of capital. Is to calculate the component cost of capital. That's step number 1. Calculate the component cost of capital. Who can remind me some of the component cost of capital? The component cost of capital that we have. Or how many cost of capital do we have? Karen tuambia, yes, but you should include what? K. So KE, cost of equity, Asante. Yes, KE, KD, and KP. Thank you so much. Those are the component cost of capital. Therefore, we start by computing those component cost of capital. Once we have the component cost of capital, now we move to the next part. So you can say IE, KE, KD, and KP. Those are the cost of capital that we shall be dealing with. So the first thing is to calculate the component cost of capital. Component cost of capital. Number 2, calculate the weight to proportion. Number 2, or Loma number 2, will be to calculate the weight. Calculate the weight all proportion. Calculate the weight all proportion. Calculate the weight all proportion of every capital component in the firm's capital structure. Proportion, the weight or proportion of every capital component, of every capital component, of every capital component, of every capital component, every capital component in the firm's capital structure. Capital component in the firm's capital structure. Firm's what? Firm's capital structure. In the firm's capital structure. So this is step number 2. And when calculating these weights, we use the market what? We use the market value. We use the market value. We use the market value. Very important. When you want to get the weight, we calculate the weight using the market value. And there are some reasons why we use the market value, and that comes as a question. What are some of the reasons why we use the market value or the market weight or the market value when calculating what? The weight. So you can have this and say that a market value are normally considered in calculating WACC. Very important, very important. Market value are normally considered when in calculating WACC because Roman number 1. So let's highlight them before we go to step number 3. Let's highlight the reasons why we use the market value before we move to the next part. Roman number 1. First of all, confirm whether we are there. Are we there? Are we there? Pale kwa Roman number 1. David Akopale. Roman number 1. Good. All right. Now, Roman number 1, why we use the market value is that investors acquire their investments at market rates. Investors acquire their investment at market rates. Hence, to review such investment, we require market value. The moment investors are acquiring the investments, they acquire them at the market rate. Therefore, if you want to review such investment, what do? You use the market value. That's the first reason why we use the market value. And this question, examiner sometimes may bring it in exam. Number two. Ya kwanza tumesema investors acquire their investment at market rate. Investors acquire their investment at market rate. Hence, to review such investment, we require market values. Roman number 2, assets used as collateral to obtain financing are always valued at the market rate. Assets used as collateral to obtain financing, are always valued at the market what? At the market rate. For example, you want to borrow some cash. You want to borrow some cash from the financing institutions, and this cash ikuwe mingi kidogo. For example, we say you're borrowing 10 million or maybe 50 million from that institution. So there is that collateral, all the security that you go with. They first of all have to value that collateral. Yes, you've come with your title deed. What is the value of this title deed? Where is this land located? What is the cost of this land? If we say we are selling this land, how is the value of the land? Is it more than the 50K or less than 50 million or less than the 50 million? Therefore, they need to value that collateral before they sign the contract of giving you what? Giving you loan. So we say that the assets used as collateral to obtain financing are always valued at market rate. So assets are valued at market rate. Number three, the optimal values are always historical values. Hence, it will be more realistic to use market value. The optimal values are always historical values, and hence it will be more realistic to use the market value. We are saying that the optimal values The optimal values are always historical. The optimal values are always historical. So we are looking at what has happened in the company. What has happened in the company. So it's historical values. Hence, it will be more realistic to use market value. It will be more realistic to use market value. So class, those are some of the reasons why we use the market value. And for this, please note, under that, I think you can write the formula of getting the weight or the formula of getting the proportion. If I talk of the weight, if I talk of the proportion, one the same thing. So down there, just write the formula and say that up. To get the proportion stroke the weight is given by value of share divided by the par value times the market value. See that? That will be the formula to help you compute what? And it is very important. That formula is very important. So weight, if you want to get the weight of proportion, the first thing you get the. So we shall be having the value of shares divided by the par value cost of the component times the market value. You see, this formula will help you to get the total what? To get the total value of that component or that source of income of that source, the total component of that source. If you're dealing with the ordinary share, you get the total value of that component. Once you get the total value of that component, you add to the other component, all of them. Now you start getting your proportion. So the value of shares divided by the par value, then you multiply by the market value. So that's very important. That's very important to note. Number 3, the step number 3. Step number 3, class, say that you multiply the component cost with their respective weights to get the WCC. Now, see, we got the component cost and we have now gotten the weight. So you take the two, you multiply to get WCC. WCC stands for what? Weighted component cost. WCC stands for weighted component cost. So you take the two, you multiply, and then you get the WCC. After that, you do what? You do summation. The last step. Sum up the weighted component cost to get WACC. Pardon the other statement. So we are saying that you multiply statement number 3 now. Step 3. Multiply the component cost. And you may compute in Roman number 1. Multiply the component cost with the respective weight. Kama ni cost of equity, you have to multiply with the weight of equity. So respective weight to get the WCC. WCC tumesema ni nini? WCC tumesema ni weighted component cost. Say that WCC is the weighted component cost. So class, we can go to last step, which is step number 4, which tells us to sum up the weighted component cost. We sum up the weighted component cost, that is WCC, to get WACC. I hope class we are together as far as that is concerned. Please confirm whether we are together as far as the steps are concerned. Are we together? Class? Kwa pamoja? Okay, since we are together, class, let's look at an illustration from May 2017, question number 1. Part C, May 2017, question number 1, C. Ya mwisho is just to sum up. You sum up the WCC to get WACC. Just sum up the WCC. You sum up WCC to get kuongeza tu to get WACC. Just sum up that and to get. Let's look at May 2017. Let's look at May 2017. That is question number 1. So somebody to share that paper. Share that paper very fast we finish up. I want us to get to WMCC as well today. If possible, if we get to WMCC, it will be the best thing. It will be the best thing. So May 2017, question number 1C. Tuko pale. I want us to concentrate. This question will help us to get more knowledge on this topic. Positive has a lot. Okay. Some people were not able to join the class. I don't know why. Oh. No. How do we help? How do we help such people? Okay, somebody to share the question. So already this is Raquel. Raquel ameshare swali pale. So class, I hope you're able to download that question. Hope you're able to download that question. I hope you're able to download that question. I hope you are able to download that question. So I want us now to read the question. I want us to read that question. So the question states that this is Upendo Limited. Upendo Limited's existing capital structure is given as follows. So that is the capital structure that we were saying. It is existing. It is existing and it is based on what? Historical data. So we have audience share capital per 20 and the value is 20,000 reserve. And then we have 10% debenture per is 100 and its value is 10,000. 8% preference shares is 20 and the value is 15,000. So the total capital structure is 50,000. But remember, under WACC, we say that we ignore retained earnings. So class, under WACC, please always ignore retained earning. We say that retained earning is an income, or it is an income generated from within. Therefore, it cannot affect us when calculating WACC. Then we have additional information here. We do that the most recent earning per share of the company is 5 shillings. The firm adopts 40% payout ratio as its dividend policy. Then we have audience share of the company are currently selling for 50 shillings each. The existing 10% debenture is currently trading at 110 shillings per of par at the securities exchange. Then we have existing 8% preference share are currently trading at 25 shillings each. Then corporate tax rate is 30%. Then class, we are required to compute several items. The first one is the annual dividend growth rate using the Gordon's growth model. It's very important to us. This is very important to us. So class, how now do we compute the growth? How now do we compute the growth here? And then cost of audience share capital, cost of 10% debenture, the cost of 8% preference share, and then the WACC of the firm. That's a very standard question. It's a question that will help us to know more. So I'll call upon everyone to be very keen to see how we are tackling this. So class, we need to compute the growth rate. This is Roman number 1. So class, for us to use the Gordon model to compute the growth rate, we need to appreciate the fact that growth can be given by B times R, where, very important, where B stands for ROE. ROE is the return on what? Return on equity. Return on equity. Return on equity. And our R is the retention ratio. So for a good student, it's possible for them to give us the retention ratio in this question. What is our retention ratio, class? What is our retention ratio, tafadhali? What is our retention ratio? What anapatia 0.6 as a retention ratio. How I wish that everyone is able to see how we are getting that. Class, the examiner in this additional information, ametupatia the payout ratio, the dividend payout ratio as 40. Additional information number 2, that the firms adopt 40% payout ratio as its dividend policy. Therefore, if we know that the firm has 100% 100% earning. So from the earning, they have paid 40%. So the dividend payout ratio is 40%. So the remaining is the retained. This is what the company remained with. They retained the 60%. That's why you can see most people are giving us 60. That is where we're getting 60. So already we have this. But class, now, do we have the return on equity? Now here, ratio comes in. So we're going to venture into ratios as well. So how do we get a return on equity, or B? Or it B. How do we get return on equity? Can you tell us the formula? Who can remind us the formula? Hapa tutakuwa na formula kadhaa. So if you don't have the highlighter, I don't know what you're going to use, because we have several formulas which are very crucial, which are very important for us, and through this question you'll be able to know very much. So how do we get the return on equity? For the shareholders, net income over shareholders' equity. Yes, thank you very much, Rathoni. Yes, it is net income over shareholders' equity. This is just a matter of knowing the formula. Shareholders' equity. Good. Thank you so much. So that takes me to the next level, where I want to know, how do I get net income? Class, another formula arises. Net income. How do I get net income now? I want to know how to get net income. I know if I want to get the total earning, or the total earning of this company, I need the EPS, or earning per share, and then multiply by what? The number of shares. NOS is number of shares. Now, what is our EPS? Earning per share? Earning per share ni ngapi? You're almost there. You're almost getting there. You should be very keen here. Formula twingi. Our earning per share is 5, as given by Tony there. Now we need to compute the number of share. This key to class. This thing we have repeated very many times. Getting the number of share, the par, and the value of share. So class, now from this point, kindly give me, from your own understanding, give me the number of shares. Hii ni kitu tumefanya mara mingi sana. Even kwa FR, even in FR we've done this. I like this. Sasa at any given point, if you don't want to confuse this, write the 3. Value of share, number of share, and then par. Ask yourself, how do we get value of share? How do we get the value of share? How do we get the value of share? How do we get number of share? Thank you for appreciating the fact that you are taking the value of share, dividing by the par, and that's why you're getting 1,000. So our number of share is 1,000. So with that, we are able to get our net income as 5,000. I'm done, because I know that I'm now able to get my ROE, my return on equity, which will be given by 5,000 divided by what? What is our shareholders' equity? Shareholders' equity need 20, the value of shares, the 20,000. So can you give me now something here? What is our ROI? What is our return on equity? Return on equity class itakuwa ngapi? Return on equity itakuwa ngapi? Return on equity itakuwa ngapi? Somebody. This one. So tuna cancel hapa, tuna cancel hapa. Si pia na cancel 5. 5 1 by 5 4. This is a quarter 0.25. 0.25. Now class, we can be able to get our G. So G will be given by, I hope it is visible, G is equal to 0.25 times 0.6 retention ratio. Done with the first one. So what is our G? It is our G. I want us to move now to the next thing. We need to adjust my camera kidogo inakaa. Our G ni ngapi? People are giving us G of 15%. Of 15%. Thank you so much. Thank you so much. People are giving us G of 15%. People are giving us G of 15%. Good. For giving us G of 15% or 0.15. As you know what? We could not have gone to the next part if we had not computed G. Because if I want now to get the KE, which is my Roman number 2, the cost of equity, Roman number 2, that is where we are. KE formula is given by DO 1 plus G divided by PO minus F minus D. This is F plus G. Our G is very important for us here. Our G is very important for us here. But now, I still have a problem. What is my DO? Please help me get DO. What is my DO? Remember, DO is the current dividend. Halafu ikumbukwe kwamba sometimes the examiner will give you D1. That is expected dividend. And D1 is equal to what? D1 is equal to what? D1 is equal to DO 1 plus G. You make the current dividend grow. DO, who is this? Walter. Asante. There is something Walter is trying to tell us here. Walter is trying to give us the clue. DO is the payout ratio. But now, Walter, complete your statement. We cannot just take the DO to be the payout ratio as such. We had been given the earning per share of the shareholders. Therefore, it is the payout ratio times what? Earning per share. Asante. Thank you so much. So our DO class is the only item that could have aided us to get this. Therefore, it is 5 times 0.4. So what is my DO? Ni shingapi? What shingapi? That is the way you flow with the question. You first of all need to understand, and you continue. Good. Now with that, we're now able to get our Roman number 2. So to get our Roman number 2, class is simple because we have everything. So 1.15 divided by, what is our market value? The market value ya owner share. Hapa unaendaga na chenye una deal nayo, unaangalia hiyo. So market value ya ordinary share ni 50. Tumepewa pale, and then plus G. I'm done with this. So somebody can give me this. Somebody to give me the KE. Sasa tutakuwa tumepata component cost ya kwanza. Component cost ya kwanza, tupate hiyo. Usonge, pate ya kwanza. Usonge. Naenda vizuri. Chapa hiyo. 0.196. 0.196. Now, that is our component cost class. And since we got the component cost, what we do is to move to Roman number 3, whereby they want us to get the KD. And how do we get KD? KD, the first thing to identify is what type of debenture that we are dealing with. Are we dealing with the redeemable or irredeemable? Now, in our case, class, Are we dealing with a redeemable or irredeemable debenture? Yeah. That is the first thing, the first step. You cannot just proceed. How? You're proceeding in which direction now? Can you first of all identify which type? Same of joint class. Where Mark? Mark. Am I really fast? Am I really fast? Ai jameni, Mark. I think my speed is fair. Am I really fast? Sijaenda haraka. Okay. Very fast. How did we get that 50? Oh, okay. Hata Joy anasema, wow, very fast. Very fast. Allah. Wah. Nataka tuende na speed gani? Tuende na speed gani? Okay, not Joy, but we want to answer. Kuna vitu una assume. Ay. Raquel, kama gani sasa? Raquel. Hey, jameni. We. Raquel, just you mention. Ay. Mark, boy. Ni gani hizo? You just mention what you don't know and then mwalimu will tell you. Hey. Mark, Raquel, ni gani? The F. Ai. Sasa kuna wenye sasa. Okay. La. Sasa nyinyi hamjafuata video. Sasa shida yenu ni moja. Hamtaki kuingia kwa LMS. Unajua hizi ni vitu, unajua ukijoin late. To recover or to get to where people are, is to visit the LMS. Sawa. Is to visit the LMS. Sasa D is the current dividend, Walter. D is the current dividend. DO, the current dividend. The DO is the current dividend. Yes. All right. So make sure that you visit videos. Make sure that you visit video. Unajua sasa hatuwezi rudia hizo vitu zote at once. At once. So if you are new, please make sure that you visit the videos. They are organized from lesson 1 up to where we are. So that is it. So let's continue and ask a question where you don't understand. Kama mngeuliza hiyo tungekuwa time is the problem, but try. No. Mark, I think you have a problem kidogo wewe. Mark, can you go through the videos? Mark, time is a problem. Now you need to go through the videos. So go through the video, Mark. Go through the videos. Find some time. Create some time. Go through the videos. All right. So class, let's look at KD. We were asking ourselves, what is the formula of KD? But before then, we ask ourselves, how do we identify the type of debenture that we are having here? Now I ask a question, which type of debenture do we have? And I've seen a person there telling us that we have irredeemable debenture. We say that we have two types of debenture, irredeemable and redeemable. Now, in this case, I cannot see the maturity period mentioned anywhere. So if we don't have maturity period, we say that that is irredeemable debenture, and what we do is to apply the formula interest over PO, which is the market price. Then you adjust for what? For tax. TX for tax. So in this case, how do we get the interest? What is the rate? Of these debt? What is the rate of this debt? The rate is 10%. And the par value, what is the par value of this debt? The par value, remember, we get interest by taking the rate times the par value, which is 100, divided by the market price. What are they saying about the market price of this debt? What are they saying? In the additional information, there is additional information there. there is additional information there. There is additional information. That is the existing 10% debenture is currently trading at 110%, 110% of par. So it is 110% over 100. That will be 110. And then we adjust for tax 1 minus 0.3. T represent tax. So in this case, I'll be having 10 over 110 times 0.7. Najua kuna wenye hajajua nimetoa wapi 0.7. I've just taken 1 minus 0.3. 1 minus 0.3, or yes, that is it. You give me now the KD. Once I get the KD class, I move direct to the KP, cost of preference share. So people are giving me 0.064, 0.064. That is what we have as well. KD, that is the cost of debenture that we are having here. So we move to the next one, which is Roman number 4, and this is cost of preference share. Cost of preference share. So our KP. Now, somebody to remind us the formula of getting the KP. How do we get KP? KP has no problem. KP has no problem. Just need to remember the formula. KP has no problem. Just have to this PD over PO. This is preference divided over the PO. PO stands for market price. PO stands for the market price. So in this case, you take the rate. What is the rate of our KP? Rate. Remember tunataka preference dividend na tunachukua rate times par. Rate is 8%, 8% times par. Par value ni ngapi? Par value ni ngapi? Par value ni ngapi? 20. Par value is 20. We divide by the market value. Na utakuwa sawa. Market value ni ngapi? Market value ni ngapi? 25. So what will be our KP? So that we move to the next part of getting the proportion of the weight of these component costs. Takuwa ngapi? A matter of division 0.64 or 6.4%. 0.64 or 6.4%. I'd like to know whether we are together up to that point. And if you have a question, ask. Are we together up to that point? Are we together up to that point? Are we together? Good to see that now, Kyle, we are together. That's very good. It's very good. Are we together? And if you have a question, you ask. Mark, we are together. Good. All right. Now, class, let's move to the next part. We get the proportion or the weight. So proportion or the weights. Proportion or the weight. So in this case now, we can have the sources. And we start with the ordinary shares. Ordinary shares in this case. Then we have the way they were following each other. So we can have the debenture. Can have debenture and preference what? Preference shares. Sasa nikwambia kwamba in this case, if you even want to get the weight, there's this formula that I need to put in mind. So I need to take the value of our shares. But in most cases, remember, what am I finding? If I take the value of share, divide by par value, hiyo nitakuwa nimetafuta nini? Value of share, divide by the par value, hiyo itakuwa nini? Number of shares. No. So in most cases, or in some cases, examiner will give you direct number of shares. Sawa. So akupatia number of share, you just have to take that number of share divided by the market or multiply by the market value. That is what you're doing. But in our case here, this formula apply. So let's apply that. What is the value of share of ordinary share? 20,000. Divide by par was 20. Market value is 50. Sawa. Unapata something. Tuende kwa ingine, debenture. What is the value of debenture? Value of debenture? 10,000. Value. Divide by 100 times 110. Remember, par value, it may be only 110% of par. So know these terms. Then preference share value ni 15k, sio? Pa ni 20, market ni 25. So tunapata total ya hizi and then we get the proportion. Hii ya kwanza itapata ngapi? Audience share ni ngapi? Audience share. Audience share. Audience share ngapi? 50,000. Hii tunaweza cancel tupate 11,000. Na hii nayo ya mwisho pata ya mwisho 18,750. We get 18,750 and then give me the totals, the total. Sasa structure ya hii kampuni it's worth this. Financed by this. Equity 50,000. Debenture 11,000. Preference share 18,750. But now we need to get the proportion. What is the fraction over audience share in this company? What is the fraction over debenture in this company? So it is a fraction of the whole. So 79. So the whole is 79,750. So can you give me let's use decimal point. Weight ndizo hizi sasa. Weight ndizo hizi. Weight ya kwanza itakuwa ngapi? Weight ya kwanza itakuwa ngapi? So it will be 50,000 divided by the whole to 2 decimal places. Hapo hivyo ndivyo unafanya. 50,000 divided by a whole. That is the proportion. 63. Twende kwa ya pili. 11,000 divided by a whole. That is weight of that security. Weight of that item. Ya pili 0. Ya tatu 0.14 and the last one is 0. 0 ngapi? Ya mwisho 24, 0.24, 0.24. So 0.24, that is the proportion or the weight of. So inamaanisha kwamba kwa hii kampuni 63% was from equity or from ordinary share. 63% of the capital structure of this company was from ordinary share. 14% was from debenture and 24% was from the preference shareholders. Preference shareholder. Plus, are we together? Are we together, Lily? Are we really together? Are we getting? Kwa pamoja hadi hapo of getting the proportion. Hapo kwa proportion tuko pamoja. Okay, now class, I want us to move to the next step. And remember, the next step ilikuwa kufanya nini? Uchukua hii, tuna multiply na ile component cost. So weight times the component cost. Now, instead of that, I give you just a general formula that you'll be using to combine the two. To combine the two, this is a general formula that if you want to compute the WACC, you'll be using. So WACC is equal to KE, cost of equity, multiplied by weight of equity, plus, sasa addition ndio hiyo, KD, debenture tunafuatana. Unafuatanisha hivi so that ikuwe easier. Weight of debt plus KP, weight of P. So hii formula means a lot to you. Means a lot to you. That formula means a lot to you. So that is the formula that we shall use. So class, what was the KE? KE yetu ilikuwa ngapi? KE yetu ilikuwa ngapi? Was 0.196 times 0.63. Tuende kwa next. KD yetu ilikuwa ngapi? KD, if I can remember, it was 0.064. Zilikuwa zinafanana times 0.14. Nafunga hapo plus KP 0.064 times 0.24. Hiyo unapata ngapi? Twende step by step. Chapa hapa. Wakati mwingine ukichapa zote unasahau something na unapata a long answer. So tuchape tu step by step. Hapa ya kwanza ni ngapi? Ya pili, ya tatu, kama hivyo. Oh, then we move. So class, can you give me the first one? What will be the first one here now? Be the first one here. Ya kwanza. Iko na multiply ya kwanza. Patia ya kwanza 0.123. 0.123. 0.12348. Somebody give me the four decimal places. Okay. Plus ya pili. Ya pili. Tuende na hizo four decimal places ni sawa. Inayo ya kwanza tumeenda 5. Ina shida. Bora pale mwisho tutapata the same thing. Ya pili ni ngapi? Hapa. Hapo. 0.00896. 896. 0.00896. Class nipatie ya mwisho, the last one but not the least, and then get the total. Get the total. Ya mwisho 1536. Haya. Sasa nipatie tu total. Total ni ngapi? Total ni ngapi? To four decimal places. Total watu wanapata ngapi? Iko change hapa. 2284. 1478, 14912. Wah, tunapata vitu tofauti hapa. I don't know why. So let's wait for several individuals to give the year. 1478, starting getting popularity. Yeah, make sure that you look at what you have. To four decimal places, 0.1478. This will be translated to what? 14.78%. So class, you know what? The cost of capital yenye umekuwa ukiona tukitumia under valuation, under the time value of money, hizo ndizo step inatumika ili kampuni kuweza ku realize the cost of capital. And this cost of capital class, remember this is now the general one. This is the general cost of capital. That means for this company to be able to get this financing, it will incur this percentage of this as the cost. So the cost that will be incurred will be equivalent to 14.78%. Cost that will be incurred will be like that. So class, what I would urge everyone is to make sure that you follow these videos very well. Follows these videos very well so that you get to understand the concept from the beginning. The concept from the beginning, and that will be very good. That will be very, very, very good. Very good. Very good. And that is it as far as that question is concerned. And now I want us to move to illustration number 2. Illustration number 2. So illustration 2, class. Illustration number 2 to come from May 2018. May 2018. Somebody to share May 2018 question number 3 boy. Question number 3 boy. So illustration number 2 coming from May 2018. Question number 3 boy. Are we there? Somebody to share in the group so that we are able to solve that question together. Solve that question together. May 2018, question number 3 boy. 3 boy. I hope everyone have the link to the past paper. The link to the past paper. Najua nazo. Oh, what happened? Some people are not able to join. What do we do? Okay, what do we do then? We just continue and make sure that we record this session. So we're looking at May 2018, and the link to the past paper is in the group description. The link to the past paper is in the group description, or under the group description, under the group description. You see what I'll be able to share with you. You see that it will be question number 3, boy. Let me see. Yeah, this is a nice one. This is a nice one to help us to just open our mind. Just open our mind. So let me share. I'm just sharing direct in the group. Kama bado hamjashare, just share. Okay, all right. There the question. That is the question. Is the question. Let's look at these question 3, boy. So class, are we there? Are we there? We there? Are we there? Haima swali inakujaga na max mzuri, max mzuri. It can be a savior. It can be a savior. So please confirm whether we are there. I know you are opening. You are opening the paper. Tuko pale kweli. I want us to be at the same page. I want us to be at the same page. Tuko pale kweli. Once I get 3 confirmation, we just move to that 2. 3 confirmation enough to represent the tip. Thank you so much. We move. All right. This is Akiba Limited. Akiba Limited has the following capital structure. We told 3 million fully paid audience shares. The value was 30 million. Retained earning to corner 20 million. 1 million 10% preference share. Then we have 6% venture. Part 150, and value is 30,000. Additional information class, we are told that the current market price per share is 30. Current market price per share. Hiyo inalingana na nini? Inalingana na audience share. So that is the market price of audience share. The expected dividend per share in the following year is 1.2. The average growth rate of earning dividend has been maintained at 10% over the last 10 years. So growth rate tumepewa. The trend is expected to remain the same in the foreseeable future. Then the debentures are trading at 110 shillings at the securities exchange or market. The debenture matures in 100 years. This is very good, very interesting. Then we are told the preference share were issued 4 years ago, and they are still trading at face value. And the corporate tax rate is 30%, and the examiner wanted you to compute the weighted average cost of capital. Because if you look at this question and the previous question, this question our examiner want you to remember several things, but the examiner did not even list for you those things. But through what we have studied, or what we have learned, is that we are able, first of all, to come up with a procedure, or follow the steps of computing the WACC. Now, in this case class, where do we start? Where do we start? When do we start class? Tunaanza wapi? Somebody. Where do we start? So tunauliza, what is step number 1? Hiyo ndio tunauliza. What is step number 1? Step number 1. We calculate the component cost. Asante. That's what we shall do. What you guys are telling us is what we shall do. Question number 1. 3C. So component cost. So we calculate the components. Nipatie ni component cost ya kwanza. Component cost ya kwanza ni KE. How do I get KE class? KE, I have a formula of getting KE. It is 3B. KE class, I have the formula of DO 1 plus G over PO minus F ni flotation cost, minus D plus G. Okay. So unasema anje 1 plus G, PO, current dividend, 1 plus G, G is for growth, divided by PO, the market price, so that share, minus flotation cost, F stand for flotation cost minus D. D is for discount if given, plus G. Sawa. Hiyo ni formula kupata KE. What I would like to know, I'd like to get this information from you. From what we've been given, shall this formula apply? Really? From what examiner gave us in this question? Please check the question and then respond. Simple. Shall this formula apply? Walter, no. Great. I like this. We already have D1. And for the new student, please note this, that D1 is equal to D0 1 plus G. Shika hiyo. Hii ni muhimu. Most of the students fail this question during this time because of failing to understand that D1 is equal to DO plus 1 plus G. We grow that to get D1. So in this case, the question is very simple for us, class. I just need to get the D1. D1 ni ngapi? So KE will be equal to D1 over PO minus F kama iko, minus D kama iko, and then plus G. Sasa in this case, can you tell me what is our D1? 1.20. Divided by PO. Hiyo ni ngapi? Market value. Tuliambiwa ni ngapi? Ni 30. Ndio ni 30, sio? Ndio ni 30. Market value. Additional information number 1, 30. Hatuna hizi vitu zingine. F ni 0, D ni 0, but G tumepewa 0.1 which is equivalent to 10%. So can you give us the KE? Tutakuwa tumemalizana na KE. K ni ngapi? Mili. So ni vizuri sana kukumbuka hizi vitu. So what will be our K here? Papewa 0.14. Sorry, that is our cost of equity. Cost of equity is 0.14 or 14%. Then plus we move to Roman number 2, get the cost of, let's see. Tunaweza angalia venye structure imepangwa, tuende na hiyo. So already tumetafuta KE ya equity. Tuende retain earning ignore. Tuende kwa 1 million 10% preference share. Sasa hapa ndio mambo ilikuwa iko tu change kidogo. 1 million 10% preference share. Then you look at information related to that. Wanasema nini kuhusu preference share? Iko additional information namba ngapi? Let me look at it. Number 6. The preference share were issued 4 years ago and they are still trading at face value. Sasa nataka uangalie vizuri class. Whatever examiner gave us in regard to the preference share. What didn't he give us? Nini hakutupatia? What were we not given? And we need it. The par value. Ametupatia number of ordinary share na ametupatia value of share. Not ordinary share but preference share na ametupatia the value. Sasa alitaka tujitafutie par. Very important. Alitaka tutafute par. So the par will be given by par value is equal to the value of shares divided by the number of shares. That will be equal to value ni ngapi? Value ya hii kitu ilikuwa ngapi kwani? Value ya hii kitu ilikuwa ngapi? Value ya preference share ilikuwa ngapi? Tulipewa 20,000. 20,000. Alafu tume-eliminate 3 zeros. Divide by what? 1,000. So pa ya hii ni 20. Na unajua namna gani class? Kama ungepata hii, ingekuwa ngumu hata kuendelea hapo mbele. Ingekuwa ngumu hata kuendelea hapo mbele because there are some of the things examiner atuambia kwamba tutumie. So in this case now we can get our KP. So KP will be given by preference dividend over PO. Inakuwa rahisi hivyo. So the rate tuko nayo. Rate walipatia. Rate ni ngapi? Well, 10%. So hii ni 10% of par, which is 20, and then market value tumeambiwa kwamba hii kitu hai kuchange, ilikuwa inatumika 20. So hapo mambo ilikuwa moto on 0.1. That's how we together as far as that is concerned. Pamoja. Tumeelewa hapo? Have you understood? Nataka tuende kwa KD, but before then please confirm whether we are together. Aya, sawa. Najua hapa kwa 20 ndio bado, hapa kwa 20 ya chini ndio Mel bado Mel has not understood hapo kwa 20. So Mel, can you look at additional information number 6. The preference shares were issued 4 years ago and they are still trading at face value. What we said under the valuation topic, say that par value, nominal value, face value is the same. We stand for the same thing. So we stand for the same thing. So they are telling us that there was no change. These shares were trading at 20, which is the par value. So there was not change. That's why we have used that. Preference dividend, take the rate times what? Times par. Always note that. Mel, I hope we are together. Mel, you're getting 10. Where did we get number of shares? Okay, number of shares. Good question here. So you look at where we have the structure. We have been told 1 million, 10% preference share with a value of 20 million. Sasa hiyo 1 million ndio number of share. This is who? Mupa. That is the 1 million is the number of shares. Are we together, Mupa? Umeelewana? Are we together? 1 million. So we've just eliminated 3 zeros because already, ukiangalia on the side of the value of share, we have eliminated 3 zero. 3 zero are truncated. We have truncated 3 zero. Tumeondoa 0 tatu. Thank you so much for understanding. Let's now move on to getting the KD. Remember, those are the three component costs that we have here. So let's get the KD. And before then, class, can you tell me, are we dealing with the redeemable or irredeemable debenture? KD, ili nijue kwamba, am I going to use which formula? Redeemable or irredeemable? Are we dealing with the redeemable or irredeemable? It is redeemable. It has maturity period. Thank you so much. Yes, examiner proceeded and told us that these bonds, these debenture, have maturity period under additional information number. Additional information number 5. The debenture mature in 100 years period. Debenture mature in 100 years period. So class, this is simple because I know it is YTM and then I adjust 1 minus T. So my YTM will be given by interest plus 1 over N. Par value minus market value. I divide by a half over the summation of the par value plus market value. And then I do what? Adjust for tax. So class, I want you to guide me and I want you to help me get the interest. What's the rate of debenture? Rate of debenture ni gapi? Unajua tunatafutaga par value. Tunatafutaga interest on par. So the rate is, people are giving me 6%. So I just have to put 6% of par. What is the par value? Par value ni ngapi? Alitupatia hapo. Hiyo ndio par value tulikuwa tumepewa already. 150. Plus 1 over 100 years. Hiyo ni n. Par value umeniambia ni 150. Market value ni ngapi ya debenture? Hii vitu bwana ni direct jameni. Once you understand the formula, it becomes very easy. What is our market value? Tumalizane na hii stuff. It is 110. People giving us 110 divided by a half of the summation. A half of the summation, the two, 150 plus 110. And then we adjust for tax 1 minus 0.3. So class, this will be very simple for us. So can we get 6% of 150? Tupate numerator hapo. Si tunaweza pata hii numerator. Ama to avoid confusion, please give me the interest kwanza. Give me the interest kwanza. Itakuwa rahisi kwangu. Interest ni ngapi? 9. Interest napewa 9 plus nipatie hapa. Usiuze huku kwanza. Hii tutaguza after tumedivide. Yeah, asante sana. Asante sana. Thank you so much. Thank you so much. So give me now this 150 minus this. That is 40. So 1 over 100 of 40 ngapi? 1 over 100 of 40, 0.4. So kanakuwa kadogo hivyo, 0.4 divide by hapa a half of the summation of the two. Hiyo itakuwa kitu kama 260. A half ni ngapi? Ni 130. Or 260, 130, si ndio? That and then to multiply na 0.7. So tuko na kitu inakaa hivi, 9.4 divided by 130. Tuko na kitu inakaa 9.4 divided by 130 times 0.7. Sasa tunapata nini? Tunapata nini sasa? Kisha chapa hivyo. Takaga step by step so that we don't complicate things. 0.051. That is it. 5.1%. That is our KD. That is our KD focus. I want you to give me the proportions. I don't know what is the time. 6:40. Yeah. You guys, you can give me the proportions of these. Start the proportion of code and share. From your end, please give me the proportions. Ama wait, ndio tutatafuta. So tunaanza na ordinary share. Twende ya preference share. Twende ya debenture. So class, muniambie. Guide me how I'll get this. Ordinary share. Nitachukua nini nikisonga kwa nini? Nitachukua 3 million times 30,000. Hiyo ni water. That is according to water. A great formula there. Number of shares times market value. Thank you so much. Now, what is our number of shares? Now, kumbuke kwamba we are eliminating 3 zeros. Number of shares. Okay, 3 million. We can even go with that million. If you want to put the whole of it in sawa, we can go with what now Kathoni is telling us. 3M times 30. You already, number of shares tulikuwa tumepewa hapo. So itakuwa 90M. Ya pili, preference share. Preference share nayo ni haraka. I know my market value ni mbao. What about the shares? The number of share. Silikuwa million. So ni 1 million times mbao. 1M times 20. So itanipatia mbao. Sindio? Alafu ya mwisho, hii ya debenture. Debenture iko na maneno kidogo. Lazima sasa tuchukue value yake. Debenture iko na value na par. Ama? So what is the value of debenture? We get the number of debenture. Value of debenture kwa ni ngapi? Value of debenture ni ngapi? From your end. The value of debenture ni ngapi? 30,000. So it is 30,000 divided by 150. Lakini sasa ukumbuke kwamba tumetumia milioni huku times market value. Market value ilikuwa 110. Sasa hii itatusumbua. Sasa kama ni 30,000, 30 ni 30 million ama hii ni 30 million plus. Sio, si tutumie 30 peke yake. Ili tuweze kupata the same thing. Tumia hiyo kwa 30 million hivyo. Tuondoe mazero hizo ili iweze kuwa mzuri. Tumie 30 million, 30M times 110. Patie hiyo. Patie hiyo tumalizane na hii stuff sasa. Patie tumalizane nayo 22. Yeah. Tuwa hivyo itakuwa 22M. So the total class, so that we get the weights. Give me the total hapa. Hii ni one ngapi? 110. Hii ni 22. 132 million. 132M. So tupate proportion. This divide by this. This divide by this. This divide to 2 decimal places. So nipatia kwanza 0 point. Taka muendelee mtafute WACC. Hii ni ngapi? 90 divided by total. 68. 0 point. Twende na 2 decimal places la kila asante. 2 decimal places ni sawa. 0 point. 15. Na ya mwisho sasa, ya mwisho ni ngapi? Mwisho ni ngapi? The last one class ni ngapi? 7. Please proceed and get our WACC. So everyone is now getting the WACC of that company. Please get the WACC of that company.